And we asked the same question because a whole bunch of people were like, okay, well, something's going to break. And after discussing it for a couple of days, the answer was the US economy. Every single time the ISM hit 50 or went through it, because sometimes it went from 52 straight to 48 or 40, every time it hit 50, the Fed cut, except one, which was 2016, where they paused. So I'm like, So there's a 100% track record of this suggesting that as soon as the economy goes, and a lot of the time, people were then, the obvious question is, yeah, but inflation wasn't high then. Well, it was in 2008, it was in 2001, it was in 1974. Inflation, they were cutting when inflation was at peak.
Real Vision CEO and macro guru Raoul Pal is deeply involved in how the general macro environment impacts the cryptocurrency, equities, and commodities markets. He was one of the first market experts to predict that the U.S. economy would slip into a recession. He made that call primarily based on an important indicator of economic growth and decline. The Purchasing Managers Index, or the ISM Manufacturing Index, is an economic indicator comprised of monthly reports and surveys from private sector manufacturing firms. It surveys product managers who buy materials needed for a company to manufacture its products and are in the best position to assess the economy's trajectory. By taking a look at the index, investors and analysts like Raoul Pal can get a clear idea of what purchasing managers think about the future of their industry. The survey informs market sentiments and provides the basis for trading decisions. If the PMI is over 50, that means the managers see an expansion of the manufacturing sector. If it is below 50, they see a decline, which usually means a general period of economic downturn. For July, the United States ISM Purchasing Managers Index dropped to 52.8 from a score of 53 in June and 56.1 in May. If the decline continues as Raoul Pal expects, we could see a drop below that important threshold. With the current market condition, that is the last thing that should happen. Why is this important? During his Friday speech at Jackson Hole, Federal Reserve Chair Jay Powell dashed all hopes of a Fed pivot, which essentially puts the markets between a relentless Fed and falling ISM. Here are some things Powell stated during his speech. While the lower inflation readings for July are welcome, a single month's improvement falls far short of what the committee will need to see before we are confident that inflation is moving down. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. At our most recent meeting in July, the FOMC raised the target range for the federal funds rate to 2.25 to 2.5%, which is in the Summary of Economic Projections range of estimates of where the federal funds rate is projected to settle in the longer run. In current circumstances, with inflation running far above 2% and the labor market extremely tight, estimates of longer-run neutral are not a place to stop or pause. Despite the firm resolve from the Federal Reserve, Raoul Pal does not think the central bank has the wherewithal to proceed if the economy continues to show strains, which Paul thinks is exactly what would happen. In a recent discussion with renowned author and CNBC contributor Larry McDonald, Pal explains how difficult it would be for the Federal Reserve to keep its promise of tightening until inflation drops to 2%, regardless of what happens with the economy and the markets. Please watch the video to the end, give this video a thumbs up, and let us know what you think in the comment section below. Also, be sure you check out our other videos to stay updated. Let's dive right in.
Do you think that we're going to need another sell-off in equities to drive this? Do we need, because right now it's been kind of messing around, not been doing much for a while, and the Fed don't feel hugely under pressure because nothing's really breaking from here. How do we get to the Fed going from, yeah, it's okay, to, okay, it's not okay, and maybe we need to readjust? Because I also think a pivot's coming, whatever that means, whether it's a pause in the QT first, which is probably the likely thing, then it's a pause in the rate hikes, and then it's we'll see, and then eventually it's, oh shit, and we have to cut rates.
You know, the last 48 hours, last week there was a lot of pressure. I mean, it was our 21 Lehman, we have an index of our 21 Lehman systemic risk indicators, and they were the highest since COVID. There was tremendous pressure in the EM side and the Europe side, and you track the European banks better than anybody, you know, especially through your career. And you could see last week what they call I track senior financials. That's one of our class. I mean, you're talking about through COVID wides. You're talking about credit default swaps on Credit Suisse, a large bank, you know, in Europe that were through the COVID levels. And so those are extreme stress levels. So I hear you. Like nothing's, we haven't broken in terms of the S&P. Like we're in a bear market, but we're not 40% lower. But I think there's enough stress. And what I really want to pass the message, and I'm hearing from clients in our live chat that those stresses around the world, the fact that the curve's inverted, the fact that, Elon Musk and Jamie and Zuckerberg, they're all saying essentially we're in recession or we're going to be in one shortly. Even Goldman Sachs has changed their tune several times over the last 2 months. So at the end of the day, the Fed knows that they're not just hiking rates in a recession. They're hiking rates at 150 miles an hour very near or in a recession. So I don't think that they need equities to crash from here. I know a lot of people say that. I just think that if they talk to global leaders, if they talk to other finance ministers, the stress in the system is so spectacular relative to the last 20 years. I mean, it's right up there with the Lehmans and the COVIDs. I think that's enough to have them at least go from 150 miles an hour capital, combination withdrawal. Right now it's 150 miles an hour relative to the rest of the world, which is going at 0 miles an hour in terms of combination withdrawal. And then maybe they just take it down to 60. That's enough to get the dollar and the euro to go the other way. In other words, dollar come down, euro go up.
Yeah, I had my global macro investor roundtable here in the Cayman Islands. I don't know when it was, I think it was May. And we asked the same question because a whole bunch of people were like, okay, well, something's going to break. And after discussing it for a couple of days, the answer was the US economy. So it doesn't necessarily, I think the markets are priced in quite a lot. And I've got various indicators to say, look, there's possibility there's more downside, another 10%, but maybe not. The bond market feels at the wrong price for me. I think yields need to come a lot lower. But everything suggests to me that we were going to see this precipitous decline in ISM. So I went back and thought, okay, does that really matter? Because, I use ISM a lot. And I went back to 1970. Every single time the ISM hit 50 or went through it, because sometimes it went from 52 straight to 48 or 40. Every time it hit 50, the Fed cut. People think that inflation needs to come down. Inflation expectations need to come down, not inflation itself.
Yeah, if the Fed internally knows they have wounded inflation. I mean, 5-year forwards, break evens. The CPI data at 9.1% is history. So right now they're stuck in what's called a false stale narrative, like stale bread. And so they were just think about the Rose Garden, the White House, and Powell was in the Oval Office maybe 3 or 4 weeks ago. He was on the Hill in terms of the Humphrey Hawkins or the annual Senate and House testimony. So he's been pitching this thing aggressively around inflation. But to your point, he knows behind the scenes, and all the Real Vision viewers have to understand this. He knows the data is turning against him, but not just a little bit, violently turning. And he also knows the wealth destruction. I mean, just Greenspan, I grew up through the Greenspan era in the business. He talked about the wealth effect. You can't destroy, $30 trillion of equities, bonds, crypto, private equity.
I looked at the global version of it. It's like 40% of global GDP has been written off in global assets.
Yes, I mean, what does that do? Like Greenspan says, what does that do to consumption 12 to 18 months out? It crushes it because the upper 50%. If you're in Florida and you're worth $10 million, now you're essentially worth 6.5. And, that person's not going to go out and really spend money the way that person would before. And then the bottom 50%, as we know, has almost no savings, right? And so they're being crushed by inflation. So the Fed, even though they're in the Rose Garden, they're in the White House, they're in the Oval Office talking this tough game on inflation, behind the scenes, bottom line is, I can say this with the highest conviction. They are so over their skis on the recession, as you point out, that it's very easy for them to walk this thing back.
Despite the certainty of a Fed pivot from Powell and McDonald, Powell's speech hints at something entirely different. In fact, he hinted that a Volcker-style tightening is not out of the question. The successful Volcker disinflation in the early 1980s followed multiple failed attempts to lower inflation over the previous 15 years. Powell stated on Friday, a lengthy period of very restrictive monetary policy was ultimately needed to stem the high inflation and start the process of getting inflation down to the low and stable levels that were the norm until the spring of last year. Our aim is to avoid that outcome by acting with resolve now. To conclude his speech, the Federal Reserve Chairman added, "We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply and to keep inflation expectations anchored. We will keep at it until we are confident the job is done." What do you think? Is the speech just a front to lower inflation expectations and put the economy back on a growth path, Or is the Federal Reserve really going all out and risking a nasty economic collapse? Please drop your thoughts, comments, and observations in the comments section below. Also, ensure you hit the like button, subscribe, and turn on post notifications for more videos like this. Thanks for watching.